Hey guys, welcome to another update with JB. We'll call it a bit of a fireside chat, sans the fireplace. Hey look, let's start off with interest rates. We're in a bit of a benign environment at the moment. We obviously saw some big rate reductions in the last 6 weeks off the back of a real change in the Reserve Bank's outlook for the economy. We've got really weak economic data out there. That's brought forward the Reserve Bank starting to drop rates. That's going to continue. The economic data isn't great, and the Reserve Bank is very much in its easing cycle now. The next OCR is on the 9th of October. I'm expecting to see the OCR drop by 1/4%. I would have said 0.5%, and in fact that's probably what I would have said last week. Why I'm pulling that back a little bit is just seeing a little too much enthusiasm coming into that housing market. I think that would be enough with the increase in consumer confidence and business confidence for the Reserve Bank to maybe want to take it a little bit slower. So 1/4% in October. There's another OCR announcement in November. I think we'll see another 1/4% then. And then look, we've got a bit of a break until February next year before we can get another OCR cut through the door. I think in February, if everything's behaving itself, we could see some bigger drops from the Reserve Bank. My view is that that's going to happen in the first half of next year. I think you'll get some pretty big cuts early on, as long as everything's sort of playing out the Reserve Bank wants to see it. There's going to be not too much excitement in the housing market, house prices not taking off again, as well as low inflation and a weak economy that requires getting to lower interest rates faster. In terms of how this translates through into house prices, falling interest rates generally means higher house prices. The counter argument to that is that we've got a very weak economy, very weak economic growth. We're in a recovery phase. People have to repair their balance sheets. You know, people don't have savings. There's lots of deferred maintenance. There's just regular shit that people have to sort out in their lives before they get too carried away. You're going to see some pent-up demand in that housing market coming in over the next 6 months because people have been putting their lives on hold now for a good year, year and a half. People are going to want to move on. That demand is coming back into the market. We can see it already. It doesn't mean that the market's going to take off again. We haven't got high levels of immigration at the moment, and interest rates comparatively are still high. So what I think you'll see is a bit of sort of topsy-turviness as people come in and out of the market. That pent-up demand starts to wane and we get back to some sort of normal. There will be an increase in house prices, but I wouldn't be expecting anything more than 5% over the next year, and I think 5% could be a little bit optimistic. It really depends on not only how New Zealand plays out over the next 6 to 12 months, but how some of our trading partners play out. You know, there's increasing risk globally with China looking like it's got a very low growth environment in the next year to 2 years ahead, and the US could be coming off the boil a little bit as well. So there's a lot to play out in this market. I think the thing you have to look forward to is lower interest rates, and I think we'll get there faster, which for me is a great relief. And as far as house prices are concerned, look, I guess it's a good news story in that hopefully we'll have a pretty stable housing market. If you're looking to sell, there'll be buyers out there. But just don't expect house prices to take off anytime soon.